folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory in Birmingham. Thought we'd come to you today with a little bit of a market update given the recent volatility that we've seen. The S&P 500 is currently at about 4375 as I talk to you, and that's about 4% off its most recent high. We've seen a couple of weeks in the red here as the market has taken a little bit of a risk-off stance. Yesterday, we saw a relatively large sell-off, the largest sell-off since May. And that was driven by a news cycle dominated by some news out of China around a real estate developer that looks like it might be having some balance sheet troubles. I'll spare you the gory details other than to say that real estate businesses, like a lot of other businesses, depend on credit as their sort of lifeblood. If you think about purchasing real estate, most of that doesn't happen with cash. Most of it is financed. And so for some reason, a real estate developer starts to become a little bit troubled and their lines of credit dry up or their ability to obtain new credit dries up, it spells difficulties for the rest of the business. And there's a little bit of worry, not unjustifiably so, about what the Chinese government is going to do about this. The company in question is called Evergrande. They have about $300 billion of debt outstanding. And while they are the largest of the Chinese real estate developers, they only account for about 4% of the overall Chinese real estate market. So it's an issue. It's not a huge issue. And certainly if you think about the composition of China in the overall investment portfolios globally, it is not a massive issue for anybody's portfolio. I think the concerns that are going on that are coming out of this are really largely driven by, what does this mean for the rest of the Chinese economy? Does it slow down? It was already slowing. Does this push it, further towards slowdown? And what does that then mean for the rest of the world? China is obviously an important global player, particularly for demand for certain commodity items. So what does a slowdown in China mean for the rest of the planet? It's not anything that I would worry about derailing our own economic growth as we explode out of COVID, but it is something that the markets have found concerning. Stepping away, though, I think the broader point that I would make to folks is that, with the S&P 500 up 17+% year to date, and a lot of optimism currently priced into the market, the market has shifted a little bit more towards fear and away from greed recently. We talk about fear and greed as a market paradigm. When people are fearful, they seek to preserve capital. When people are greedy, they seek to invest capital and take advantage of take advantage of the market gains, put capital to work. And I think just with the really impressive returns that we've seen year to date, as well as the relatively low volatility environment, it's pushed a little bit more towards the fear camp. People are a little bit nervous. They may be looking to lock in a little bit of gains. When I layer on top of that, the spread of the Delta variant, consumer sentiment that's been meh at best for the past few months, a dearth of earnings. And what I mean by that is we're not quite in earnings season yet. We've still got a couple of weeks to go before companies can come back to us and talk to us about, how things are doing, as well as some fears about the Fed and what they're going to do as they start to taper interest rates. It just doesn't create a whole lot in the markets right now to be excited about. Do I think that sentiment's going to be long lasting? No. Do I think it's anything that you need to worry about if you're a strategic investor? No. It's been a remarkably quiet year. If we get a little bit of a pullback here, it wouldn't surprise me. Not anything if you have a strategic asset allocation that you need to worry about changing your asset allocation for. But it is something to just be aware of as we think about, how the market's behaving. We've come a long way in a very short period of time. And if we give a little bit back, that's actually a little healthy for markets longer term. So with that, as always, if you have any questions, please feel free to reach out to me or to your advisor. I hope you're all having a great day, and I look forward to talking to you again soon.
Are you enjoying this content? Please subscribe to our YouTube channel or follow us at RFG Advisory on Facebook, LinkedIn, and Twitter.